Silver is $64 on your screen, so why are dealers saying allocation, backorder, and call for pricing? Because the market you're watching isn't the market that's buying. Someone may have already pre-claimed next year's supply before you even clicked add to cart. You and I are being shown a price every day, but the market we're trying to participate in isn't the same market the real buyers live in. When most people hear silver demand, they picture coins, bars, YouTube stackers, maybe a mint selling out for a week. That's the retail story. It's loud, emotional, and easy to see. But the industrial story is quieter, contractual, and ruthless, because an industrial buyer doesn't get the luxury of waiting for a dip. If you're Tesla, a battery supplier, a solar manufacturer, or a defense contractor, silver isn't a trade. It's a non-negotiable input. It's a line item that decides whether factories keep running, whether delivery deadlines get met, whether penalties get triggered, and whether your competitors steal your market share while you're stuck explaining material shortages to shareholders. And here's the problem we need to define clearly before we go any deeper. Retail investors think they're competing with other retail investors for silver. In reality, retail is competing with industrial procurement departments that plan 12 to 24 months ahead, sign forward contracts, pay up for guaranteed delivery, and treat silver as strategic inventory, because for them, running out is not an inconvenience. It's a catastrophe. That's why the shelves don't slowly tighten anymore. They go from available to gone almost overnight. Because the metal doesn't disappear in a dramatic Hollywood scene. It disappears on spreadsheets, inside supply agreements, inside offtake deals, inside quiet clauses that say, deliver X ounces per month, at Y premium, no matter what spot says. So when people ask, why can't I buy silver near spot, they're asking the wrong question. The better question is, who already bought next year's silver before you even showed up? Because the industrial world doesn't wait for panic. They prevent panic by pre-buying supply. And in late 2025, with silver whipping around the $60 to $65 range and physical tightness showing up across the supply chain, the incentive to lock in 2026 supply has never been stronger. Now let's talk about the core claim behind this episode, and I want you to treat it like a working hypothesis we're going to pressure test through logic, incentives, and what we can observe in the real world. Major industrial players across EVs, batteries, solar, and defense have quietly moved to lock up an enormous chunk of 2026 silver supply through forward purchasing and offtake agreements, on the order of hundreds of millions of ounces, leaving retail to fight over scraps, higher premiums, and delayed delivery. And whether the exact number is 250 million ounces or 300 million ounces, the mechanism is what matters. The mechanism is the trapdoor. Because if industrial demand is pulling future supply into the present, if next year's production is already spoken for, then the available market that retail believes exists is smaller than it looks. Much smaller. Let's define what locking supply actually means, because people hear forward contracts and they assume it's paper, it's financial, it's optional. For industrial users, it's the opposite. 1. Forward contracts. A manufacturer agrees with refiners or suppliers on scheduled deliveries for future months. Often with pricing formulas tied to spot plus a premium, with minimum quantities, and penalties if delivery fails. 2. Offtake deals. A buyer signs a longer-term agreement, sometimes directly with a miner or a refiner, to purchase a defined portion of future output. Not, if available. Allocated. Reserved. 3. Inventory financing and strategic stockpiles. Companies, or the banks behind them, finance the buildup of working inventory so they can survive shortages. That metal is not coming back to retail. It's sitting in industrial channels. 4. Substitution and thrifting programs. Yes, companies try to reduce silver use per unit. But that takes time, re-engineering, qualification, and reliability testing. You don't thrift silver out of a mission-critical defense component because Twitter is excited. The reason this matters is simple: if those contracts exist at scale, then the spot price becomes less meaningful to physical availability. You can have a quote on a screen and still have a market that feels empty, because the real metal is already allocated. This is why, in shortage conditions, the market splits into two worlds. The headline world, a number on a screen. The procurement world, can I get 50,000 ounces every month for the next 18 months, and will it be the right purity, in the right form, delivered on time? If you can't answer that second question, you don't have supply. You have a story. Now, why would Tesla, Samsung, and defense be central to this problem? Because they sit at the intersection of three brutal realities. Reality 1, silver is performance critical. It's not just used. It's used because it is the best conductor. It performs under heat. It performs under load. It performs under stress. In high-reliability electronics, power contacts, specialized coatings, and certain solder and bonding applications, silver is chosen because failure is expensive, or fatal. Reality 2, these industries cannot tolerate supply interruptions. EV and battery production runs on scheduling. Miss a window, and you don't just lose units, you lose market share. Defense is worse, you don't get to tell a government contract, sorry, the supplier network was tight. Reality 3, when shortages start, procurement does not behave like an investor. Investors say, price is up, I'll wait. Procurement says, price is up, and if I don't secure supply now, price won't matter because I'll have none. That is the psychological flip that changes everything. So let's lay out the actual problem statement for the viewer, especially if you're a retail buyer who thinks you still has time. The silver market is entering a phase where the primary competition is not between investors. It's between industrial survival buyers and everyone else. And survival buyers do not buy like you. They don't dollar cost average. They don't care about a perfect entry. They don't brag about stacking. They sign. They reserve. They allocate. They remove supply from the visible marketplace. Here's what the public typically sees: news about EV growth, solar installations, geopolitical tension, maybe a headline about critical minerals. That creates the impression demand is rising gradually. But the industrial response to rising demand isn't gradual. It comes in steps. First step, internal risk assessment. Procurement teams and CFOs ask, what's our exposure? How many grams of silver per unit? What happens if premiums double? What happens if lead times go from 2 weeks to 16 weeks? Second step, supplier escalation. They push suppliers for guaranteed monthly allotments. They offer to pay for priority. They ask for allocation letters, not just quotes. Third step, forward coverage. They cover 6 months, then 12, then 18. Not because they want to speculate, but because their vendors start warning them, we can't promise availability unless you contract it now. Fourth step, the quiet squeeze on everyone else. Once the biggest buyers contract the pipeline, the remaining market becomes a thin layer. And that thin layer is where retail fights. So the fear we're dealing with in this episode is not silver is going up. The fear is, when retail finally panics and runs to buy physical, the physical will already be allocated upstream. That is why I'm framing this as an industrial PREBUI shock. Not a shortage you hear about after it happens. A shortage that is engineered in advance by the people who can't afford to be last. Now, you might be thinking, if this is real, wouldn't it be obvious? No. And that's the most dangerous part. Because industrial locking happens quietly. It doesn't trend on social media. It doesn't show up as a dramatic announcement saying, we bought silver. It shows up as longer lead times, bigger minimum order quantities, more allocation language in supplier emails, rising fabrication premiums, more out-of-stock messages for specific products and sizes, more cash and carry behavior in the supply chain. And while retail argues about whether the chart is bullish or bearish, the real market is doing something else. It's turning silver into reserved inventory. This isn't a conspiracy theory about one company controlling everything. It's more cold-blooded than that. It's a coordination without coordination, because everyone is responding to the same incentives at the same time. If you're Tesla and you believe 2026 could bring tighter export controls, higher industrial demand, and unstable supply, you don't wait for confirmation. You move first. If you're Samsung SDI and you're scaling advanced battery tech, you don't risk a single point of failure in your material stack. You buy coverage. If you're defense contractors and you see global tensions rising into 2026, you don't tell procurement to check again next quarter. You lock supply and you bury the details under procurement categories and supplier confidentiality. So the problem is not a single event. It's a structural shift in who gets priority. And that brings us to the retail nightmare scenario we're going to build the rest of this video around. By the time retail realizes the physical market is tight, industrial buyers may already have written the checks, signed the contracts, and effectively pre-claimed the metal that would have otherwise flowed into the open market. Retail will still see a spot price. Retail will still see charts. Retail will still see headlines. But when retail goes to actually buy size, when the crowd finally turns the paper narrative into physical demand, the response won't be, "Sure, we can ship next week." The response will be, "Backordered. Allocation. Premium updated. Limit 1. Delayed. Call for pricing." And at that point, it won't matter what you believed about manipulation, charts, or targets. Because the only question that matters in a physical squeeze is brutally simple. Do you have metal, or do you have a quote?